Welcome to this discussion of the macroeconomic details that are coming out on the inflation and the industrial output front. The inflation number for the month of July has come in at 6.71, a shade lower than this, a shade higher than the 6.68 that the CNBC TV18 poll threw up. But, well, that's neither here nor there. I would say that this has come in line with expectation. 6.7 was our poll, and it's 6.71. So not much to squabble about. Important to note that this is the fourth month of receding inflation. We hit a high of 7.8 in the month of April. And since then, as you can see, April, May, June, July, as the bar chart is showing, we have been going down, and now it is a full 110 basis points lower or 108 basis points lower than what it was in April. So this should give us a lot of satisfaction. The 6.68 number. Just a word on the industrial output number. That's come in at 12%, if I'm not mistaken, and that compares better than the 10% that the CNBC TV18 poll threw up. I'm referring to the IIP number at 12.3 is better than the 10.3 that the CNBC TV18 poll threw up. But you know, all these large numbers are only because previous June, we had a terrible month because of the Delta lockdown, the COVID lockdown. And ever since, we have had these fabulous big numbers in May and June. But that doesn't mean much. Industrial output at 12.3 is a shade better than the 10.3 that our poll threw up. That's that. We will come to the details of the industrial output story in just a minute. For the moment, we are concentrating on CPI, which is, of course, an important parameter for making policy for the Reserve Bank. It's important to note that this is the sixth month that the inflation is above the Reserve Bank's mandated upper threshold. The Reserve Bank and the Monetary Policy Committee are mandated to keep inflation at 4% plus or minus 2%, which means they have to keep inflation above 2 and below 6. It's been above 6% for 6 months in a row, and therefore it's likely that the MPC will have to write a letter to Parliament in October or November explaining why it failed to keep inflation below 6% for 9 months in a row. But that topic a little later. For the moment, food inflation is what we should be looking at 6.75. That's a bit of a bother. It's not coming down as fast as one thought it should. And let me give you some other numbers in terms of inflation. Just give me a minute. Yep. Cereals are going at 6.9%. That's a worrisome number. Meat and fish 3%. Eggs have fallen 3.8%. So that's positive on the protein front. Milk and milk products again 5.8, below the average food inflation. That is oils and fats 7.5. That's a big come down. We were running at 13 and 14% immediately after the Ukraine war, and now that's come down to 7.5. So clearly edible oils globally are also cooling off. What else do we have? The fruits 6.4, vegetables is 10.9. That's really the one that's biting the most, vegetable inflation. And then you have sugar again down just 4.8, pulses 1.18. So not much of an inflation over there. Let's come to the other non-food categories, which is clothing. Clothing and footwear is up 9.9%. So that's a clear extent of core inflation, which is snaking up. So clothing is up 9.5 and footwear up 11.9. So both those are terrible numbers. Housing is up just 3.9, not much of an inflation there. And then we come to the services. Household services 7.5% higher. Health up 5.5%. Recreation up 7%. Education has softened a bit after the May and June reading. It's now up 5%. Personal care and effects is up 6%. So overall miscellaneous, which is normally for services, is 5.91%. I will wait for the core sector, core inflation number. We haven't yet got that. But with these preliminaries, let me invite our guests for their comments. I'm joined by the Indranil Pal, the Chief Economist from Yes Bank, Rupa Regan-Itsure, the Chief Economist from L&T Financial Services, Lakshmi Iyer, President, Chief Investment Officer, Debt at Kotak Mahindra AMC, and Nikhil Gupta, Chief Economist, Motilal Oswal. Ladies and gentlemen, it's an equally divided house between the ladies and the gentlemen. Thank you very much. Rupa, your thoughts first. 6.71. Are we nicely declining?
Certainly, and I feel that India's policymakers also need to be given credit for that, because they reduced taxes on edible oils in a very timely fashion, and also on fuels, etc. So, you know, the pump prices of petrol, diesel have come down. So, despite the fact that July we had so much disruption in vegetable and fruit supplies because of heavy rains, sequentially, you know, inflation easing like this is definitely a positive sign, and this augurs well for overall consumption momentum, which has just started picking up in India.
Okay. When do you see the inflation coming below 6, Rupa?
See, currently saying, hazarding any guess doesn't make sense, but I personally feel that in the fourth quarter, we may get, you know, inflation below 6%.
Yeah.
Because the agrarian situation is really panning out to be well. I mean, the Kharif has suffered because of shortfall of paddy, etc. But overall, if you see, until today, more than 30 subdivisions out of 36 have received normal to excess rainfall. That augurs very well for Rabi prospects. So overall, food grain and horticulture production is going to be better, and that augurs well for inflation.
Okay, yeah, I guess that's also the Reserve Bank's estimate, right? 5.8 for the fourth quarter. Indranil Pan, I read out some of the numbers to you, internals. What's your take on inflation? You think less and less to worry with each passing month, no?
So I'll sort of start off where Rupa left. Yes, it is positive that inflation is coming down. But having said that, I think in terms of the global mineral prices, in terms of oil, we seem to have found a very solid floor. And some of the prices in terms of, say, the metals are again, once again, on a bit on the rising side. In terms of the food inflation, Rupa did mention about the worry that we have in terms of Kharif. However, rice stocks continue to be adequate, and I don't think there is too much of a significant price pressure that can be expected out there, except for the fact that the vegetable prices, once again, if you look at August, vegetable prices have been once again rising. Not typically the onions and the tomato, but the brinjal and some of the other vegetable prices have actually been rising during the first few days of August. So overall, I think the policymakers need to continue to be watchful of inflation. Yes, inflation has come down, but the pace of decline from here on could actually be slower than what may have been anticipated.
Okay. Yeah, that's a fair point. Nikhil, you know, the bigger fear about inflation is not immediate. I mean, perhaps there is almost consensus that in the fourth quarter, inflation may come down below 6%, or maybe it will be at 6%, according to some economists. The bigger fear is that it is not falling to 4% anytime soon. Your thoughts?
Thank you, Latha, for having me on the show. Yes, I agree that if not Q4, then Q1 FY23, it will be 6% or below 6% actually. And even we do not see it falling to 4% in FY23 as well, FY24 as well. Though we expect it to be somewhere close to 4.8 to 5%. So yes, I share your concern that we do not see it falling to 4%. And if the RBI wants it to fall 4%, then they will have to wait longer, which means that probably there could be a prolonged pause. Or if they wanted to want to see 4% early, then they have to be much more aggressive than what they have.
Oh, absolutely. There are sources who say, even close to the central bank, that they are not seeing 4% come for the next 2 years. So that will be a telling point. The Reserve Bank can pause, but can it cut? Because 4% is nowhere on the horizon. But that debate a little in a bit. First, Lakshmi, this is not non-news for the bond markets. After all, you all are only tracking crude, isn't it?
Yeah, hi Latha. We are not just tracking crude oil
global US yields, okay.
No, US yields, and of course, to some extent also how the vegetable prices, especially the food prices in the larger pack, are also panning out, because that has got a very, very strong potential to, pull down the inflation and equally pull it up. So therefore, obviously, to that extent, yes, crude oil globally is important, but if you see overall food prices globally have seen a deteriorating trend after having ticked up 20% plus since the start of this calendar year. So I think that's clearly a positive factor. Of course, the traffic on the road is bad when it rains, but when it rains, the reservoir fills. So that's another thing which the bond markets also do track. And we are running about 7% above normal as far as monsoons are concerned. So yeah, these are some of the happy signs which bond markets are tracking apart from just crude oil prices.
Okay. Well, so tomorrow, not tomorrow, sorry. Tuesday, not much reaction to these numbers.
Yeah, Tuesday is, again, bond markets are closed, but I think it's largely in line with expectations. So I think the bond wallahs can actually enjoy their extended long weekend.
Okay. But basically, you're not expecting, as and when the bond markets open on Wednesday, also no reaction to these numbers. They are absolutely in line, right?
They seem to be fine. If it's doing marginally lower, it would have been a continuation of buoyancy, but otherwise nothing much. Back to global factors again, looks like.
Okay. Well, now let me come to the larger question, Rupa. Is this the fear? I mean, how do you see the Reserve Bank, rate hike trajectory over the next 6 months?
See, as I've been saying it in all your interviews, it's really the US that is fighting inflation, and rest of the countries, especially emerging market economies, but they are in a reverse currency war, and they are trying to protect their currencies. I think RBI has played a very reasonable game because they know that we are just recovering from a massive disruption, and even before COVID, we had severe slowdown. So, if you see last 2 months' experience, globally more than 64, 65 central banks have raised policy rates anywhere between 50 to 100 bips. And Reserve Bank of India has been raising it at 50 bips, which is personally, I feel, is on the lower side. It's not very aggressive. And that is because of that, we are not facing huge disruption. So if now there is a lot of positivity in global environment because US, consumer inflation as well as producer price inflation has eased, and, their retail sales data, etc., are not very encouraging. So again, there are expectations that they may not be aggressive. But personally, I feel since they are following the rule book very strictly, they may go for another aggressive hike. And if that happens, then Indian Central Bank will also have to follow suit. So, anywhere between 60 to 100 bips is given for...
1 minute. So, you're putting it at 6 to 6.5% as a rate before the Reserve Bank pauses?
Not 6.5, but at least 6.
Okay.
By
6
end
before,
of this
at least 6, and only then you can think of whether they would pause or not.
Yeah, but they will remain data-driven, and I don't think they are following any particular target. This is like a derived strategy.
Fair enough. Yeah, of course, it's all moving parts. In terms of how rival central banks behave, as also how prices move. But Indranil, again, to come back to the question I asked Nikhil, what is the best guess on when 4 will be even in sight? Logically, the Reserve Bank cannot cut till it sees that. Now, I don't know when it will pause, but certainly it will have to keep at maybe 6 or even higher if 4 is nowhere on the horizon, right?
Okay, now, inflation obviously is not a thing of an immediate past. It has been developing for quite some time, including the supply shocks and the Russia-Ukraine crisis. Now, if you look at the supply chains are getting better, but they are still higher than the historical levels, which necessarily means, and in an atmosphere where deglobalization is the norm across the universe at this point in time, the globe may actually have to suffer inflation for a longer time than we are anticipating at this point in time. So in the very near future, at least for a 12 to 18 month period from here on, I don't think the Reserve Bank has any scope of cutting. I concur with Rupa in the assessment that the RBI would raise it to a 6% level. And if the inflation actually comes down to a 5.8% in the fourth quarter and the 5% as is being anticipated by RBI at this point in time, a 6% repo rate would be consistent with that. But beyond that, I think it's an open game. It's a lot of moving pieces, but we will possibly see most of the central banks actually holding on to rates for a significant period of time after they have reached their so-called peak levels.
Okay. Yeah, there was an expert arguing very strongly from StanChart yesterday that after the US CPI came in a little softer than expected, chances are the Fed may pause maybe even later this year itself, but it is not going to cut next year. It may postpone this year's hike to next year. That was his argument. There's no question of any pause or cut any time in the next 1 year, according to him, because inflation is not seen falling. It may fall off from 8 to 4, but it is not coming to 2, according to many of the experts from the United States as well. So the more immediate question to both of you as well, Rupa and Nikhil, Lakshmi and Nikhil. Nikhil, what's your sense? The Reserve Bank reaches 6 by December and then pauses?
Yes, Latha. Earlier, I was expecting the terminal rate to be 5.5%, but they're already at 5.4.
Yeah. So
I believe there could be 2 more rate hikes, somewhere between 50 and 60 bits, and which puts the terminal rate, according to me, close to 5.96. After which, we also see a prolonged pause. We do not see a cut either by the Fed or the RBI in CY23 or FY24.
Fair point. And Lakshmi, is that what is factored in the prices now? 6 by December?
Yes, Latha. In fact, the swap curve, even at the current juncture, has priced in more than 6% on the repo rate, though some bit of paranoia has receded. But yes, I think bond markets are going with the fact that we could be at least 50 to 60 basis points higher on the repo rate between now and probably December end. It could be as early as the next month end, so that you enter the busy season with a reasonably high perched repo rate and well into the parliament session. So I think that's what the bonds are going in with right now, both on the cash market as well as the derivatives market.
Okay, very quickly, I wanted your view on whether this 6% can deter growth, Nikhil. You don't see that wanting you to change your numbers on GDP or earnings?
No, Latha, we are already not among the optimistic on growth front. We have been concerned on growth for some time now. We believe FY23 growth will be close to 6.5%. In fact, we are surprised that even after RBI has hiked rates by 140 bits in terms of repo rate and another 60 bits is expected this year, the RBI since April has not cut its GDP growth. They have kept it at 7.2%. We believe there is a risk to growth. It could be between 6 and 6.5% in FY23. We were close to 6.5% at the beginning of this year. We're now close to 6.2, 6.3 for FY23.
For FY23, current year you mean?
Sorry?
You mean the current year? In current year, you expect to be not even 6.5%?
6.5%. Next year, it could be close to 5.5%.
Well, the forecasters survey that RBI did brought it at 7.1. So, yeah, clearly yours is lower than the consensus. Indranil Pan,
yes.
Let me come over to the growth figure as well. I don't know whether there's much to discuss in the IIP number. It's come in at 12.3%. And electricity is growing fine at 16.4%. Actually, electricity is the one that's absolutely up and away. Any comments on industrial growth?
I think the initial comments you only have made in the sense that there are a lot of base effect plays that are happening in the industrial output. I have not really seen the month-on-month number that has come out. But broadly, I think for us, growth is at 7% for this year, going to about 6.5% in the next year. That's the initial estimates that we have for the FY24 at this point in time. Obviously, growth has a downward bias for us, given the fact that the higher inflation is cutting into the balance sheets of the companies. So manufacturing growth may be actually lower than what has been anticipated. Personal consumption expenditure is suffering, and the government possibly has not been as aggressive as we had been expecting in terms of its expenditure, especially on the capex side. So all that taken together, and of course, let us not forget that the net trade, that is likely to be a huge drag on the GDP growth in the current financial year. So all that taken together, I think our 7% has a downward bias. We are waiting for the first quarter numbers to come out to actually change that 7% number that we have at this point.
Yeah, I do have a grouse with the first quarter number. It's coming on Ganesh Chaturthi day. I was hoping the NSO will change its mind, but it hasn't changed its mind so far. Well, Rupa, final question to you on growth. IIP number at 12.3. Regardless, your overall picture, I mean, the power sector growth, which wasn't much affected even during the COVID months, is chugging on fine. Your comments on growth, would you also be cautious?
Actually, you know, I'm a bit more optimistic today than about I was a month ago. And in power sector also, you know, earlier the growth was coming more from the states where residential consumption was higher than industrial consumption. But now power consumption has increased in industrial states, which is a very positive sign. And I feel overall growth momentum has certainly picked up. And personally, I don't feel that the way RBI is executing monetary policy in any way, you know, interest rate hikes will act as a deterrent for growth. If at all, it will be the raw material or input price inflation and demand situation, how it pans out, and you know, the agrarian situation, because in terms of aggregate monetary demand, I think a major portion comes from rural belts also. So these are more important factors than monetary policy. In any way, our monetary policy is not as aggressive as we are seeing in other parts of the globe. So I am a bit more optimistic on the growth front.
Okay. Well, we will have to leave it at that. Actually, we have arrived at a nice consensus among our experts. The expectation is that the number itself is benign, expectedly so. And going forward, you will see inflation probably dropping towards the 5.8, but the Reserve Bank and the MPC will have to write a letter probably in after October 12th, right? The September numbers will be known on October 12th. So thereafter, I think within a month, they will have to write a letter to Parliament explaining why they failed to keep inflation below 6%. That would mean a hawkish RBI definitely up until December. You can't be writing a letter to Parliament and not hiking rates. So perhaps 6% is a given. Thereafter, one will have to see how inflation itself progresses, whether the Fed pauses, considering that inflation has peaked off over there, and what the Reserve Bank's forecasts say. You will get a monetary policy report in September, the half-yearly report, what it forecasts in terms of inflation next year, and whether the Reserve Bank, after having promised Parliament, will have to keep at it to ensure that you get to 4%, in which case cuts are certainly not on the anvil in calendar 2023. On growth, there is a bit of pessimism. The number itself is stronger than what our poll threw up. I mean, the June IIP number, but this is a lagged number. June IIP is what we are talking about. Experts are worrying that given perhaps global recession and even some domestic factors, maybe the K-shaped recovery, demand drying up in rural India, you could have a problem with growth. 7% is what Yes Bank is saying, and they see a downward bias to that. Rupa, of course, is more optimistic. Nikhil is way more pessimistic about growth. With that, we wrap up on this special broadcast on the state of the economy. Keep it with CNBC TV18. Lots of news and updates lined up for you.